If you had asked me 10 years ago or 20 years ago or even 5 years ago, hey, if we actually had a unilateral action against Iran, what would the market do? I would have never predicted that it would have been as so little disrupted as we've observed today. Mm-hmm. So Steve, what are you making at this? And are you more worried than the markets?
I am much more worried than the markets. So if the Strait were to stay closed for months, not weeks, but months, we're going to see the global economy grind to a significant slowdown. It's not just a higher price of oil. There's not going to be the molecules to actually keep things running. We're already seeing hundreds of gasoline and petrol stations being closed in Australia, New Zealand, the Philippines, Thailand. We are hearing the air products companies declaring force majeure on deliveries of helium. There is damage to the LNG facilities in Qatar. There's damage to some of the refineries in Saudi Arabia. We are in the fog of war, and what we read and what we really know is incredibly important because we're just not 100% sure. So because it would be so terrible and gasoline prices would go to $6 in the US and other poor countries wouldn't even have it, you'd have rationing and stock out, is actually the reason why we think it shouldn't go on for that long. It will be awful for so many people involved. You have 21 countries already supporting a global contingent to try to get the Strait opened. If this goes on for even long enough, it wouldn't shock us if the Chinese start helping out, whether overtly or behind the scenes. But we're at this point where markets are pricing in a degree of risk, but not nearly this sustained level. And this period that we're in right now, to Frank, to your opening point, is there is just a wide range of outcome in how this plays out, which makes it difficult, and we have to remind ourselves to observe, not predict.
So as it gets to portfolios, what does this imply about how we're positioning portfolios in light of this?
In a world where we have these outcomes that could be very, very wide, most client portfolios have positions and exposures that would benefit to some extent in one outcome and be hurt by one outcome versus benefit to another outcome and be hurt by another outcome.
You're talking about balance.
Balance.
And to be clear, balance to us is not a 60-40 portfolio.
Correct.
That's another video. We are not 60-40 guys. Mm-hmm. We would argue that's an imbalanced portfolio, ironically.
The portfolio is constructed to breathe.
Absolutely, well said. Speaking of breathing, what's happening to gold? Gold is acting like it's not breathing right now. Isn't gold supposed to be like the thing that's disaster-proof, or it's a disaster hedge? And here we are coming into this, and gold is down. What's behind that?
We would have thought in an environment with a war breaking out, oil rallying, inflation pressures going up, the gold should generally be bought, and it normally has been bought in situations like this. What we are observing and what we think might be going on, because you never really know, sometimes the news is the price. Turkey has announced that they have sold 22 tons of gold. There's some commentary out of Poland that if they have to increase their defense expenditure, they might look to sell some gold to fund that. Gold isn't necessarily stored in a lockbox and never opened up, so sometimes that dry powder needs to be opened up and used. On top of that, gold had a year in 2025 where it was up over 60%. You get a lot of momentum chasing, you get a lot of short-term interest into it, and we are seeing a combination of potentially some of the surplus saving nations that might have cash flow issues, selling some gold on the market on top of some faster money that went into gold, also potentially putting some downward price on gold. Long term though, think about what's going on here is so supportive of gold in the longer term. What's happening is likely inflationary. What's happening is less dollar friendly going forward, and it should benefit with gold and gold pricing over a period of years, not necessarily a short period of time. So when we think about it, we don't want to do anything there, but I'm definitely surprised at how weak gold has been into this. versus what would normally happen in a global conflict.
Yeah, I mean, the last 2 years it's been so incredibly strong. Gold has been a central part of our portfolio of just about every client, going back to 2015, and we continue to see it as a long-term hold, as a alternative currency in a way. But as that gets to just other types of investments that are, how would I put it, a good balance to breathe in a certainly a bad scenario. We know what goes up in a good scenario. What else could help in the bad scenario from a strategy perspective, big picture?
So if we define bad as highly inflationary, molecule short, and higher discount rate, unclear supply chains, what should benefit there is anything that benefits from strong inflationary pressures or true hard assets. So commodities should do well, precious metals should do well. Some of the trend following strategies, if we were to be going down and trending down for a period of time, should do well. Energy obviously would do well in that scenario. And then on the flip side, equities would perform poorly. Anything with a long duration asset, long duration fixed income also perform poorly, and anything that's exposed to credit spreads widening would perform poorly.
Yeah, I know one topic internally in our research team is just with the observed level of volatilities in markets not being what we would have expected. That implies to us that certain options which can be used for hedging may be not priced as efficiently as we would have assumed. So if you believe that we are going to enter into a world that is more volatile than we're seeing expressed in markets today, that might imply that it's an attractive time to use things like options as a hedging tool. The goal is to try to protect against sudden and severe downturns in equity prices that at least do not appear to be priced into volatility at this point.
So you're saying it's a cheap umbrella I keep in my car that I hopefully never need.
Exactly. It's like that little cheap throwaway umbrella. Exactly. You hopefully don't need it. You probably won't need it, but you're damn glad you got it with you. All right. Well, here's to a never dull world. We are trying to keep our eyes open and move forward, observing, not predicting. And as always, we're here to address questions as you may have them. Please reach out.